You don't own your credit score. You can't see how it's calculated. You can't opt out. Yet this three-digit number controls whether you can buy a home, rent an apartment, get a job, or even turn on your electricity. 10 billion credit scores are sold every year in America. That's $10 to $30 billion flowing to FICO and the big three for selling information about you. Information you never agreed to give them. Information they profit from while you bear all the risk when they get it wrong. And they get it wrong 25% of the time. Here's what should terrify you. You're being judged by a system you didn't consent to, scored by an algorithm you can't see, by companies you never chose. And when it's wrong, you have to prove it. This isn't an accident. 4 people across 70 years built a system where your financial identity is owned by corporations, where their errors are your problem, and where escape is impossible. Let me show you the 4 architects and the exact moments they locked you in. Architect number 1, Bill Fair and Earl Isaac. Before 1956, credit decisions were human. You walked into a bank. The loan officer looked you in the eye, reviewed your employment, maybe called your references. It was subjective, yes, sometimes biased, but it was negotiable. You could explain circumstances, you could make your case, and the decision was made by a person who understood context. Credit reports existed. Local bureaus kept lists of who paid their bills and who didn't. But there was no universal score, no single number that followed you everywhere. Bill Fair changed everything. Fair was an engineer. Earl Isaac was a mathematician. In 1956, they started a company in a small apartment in San Rafael, California with $400 each. Their pitch was simple: replace human judgment with mathematics. Create an algorithm that could predict who would repay loans and who wouldn't, based purely on data. For 30 years, they refined the model. In 1963, Montgomery Ward bought in. Credit card companies started using variations in the 70s, but the real breakthrough came in 1989. Fair Isaac released the FICO score, a single 3-digit number between 300 and 850 that could grade any American's creditworthiness instantly. Here's the genius of it. The score is based on 5 factors. Payment history counts for 35%. Amounts owed, 30%. Length of credit history, 15%. New credit inquiries, 10%. Credit mix, 10%. Sounds fair, sounds objective. But here's what nobody tells you. The exact formula is proprietary. It's a trade secret. You can know the categories, but you can never know precisely how your actions translate to your score. There's no appeal, no conversation, no context. Took out loans for medical bills after your kid got sick. Doesn't matter. Your elderly parent added you as an authorized user on their maxed out card to help them. Your score drops. Got divorced and your ex-spouse stopped paying the joint account. Algorithm doesn't care why. It only calculates risk. And here's the trap. Because it's objective mathematics, it feels fair. But objectivity without context isn't fairness. It's just the automation of judgment. And you've lost the ability to be judged as a human being. By 1991, all 3 major credit bureaus were using FICO scores. Equifax, Experian, TransUnion. Every bank, every lender, every credit card company could pull your score instantly. 3 digits that summarized your entire financial life. Bill Fair died in 1996. Earl Isaac retired in 91. Neither lived to see what they created become inescapable. But their legacy is a system where 200 million Americans are reduced to a number generated by a secret formula owned by a private corporation. This is the first lock. Your financial identity is now a number. You can't opt out. You can't negotiate. You can't explain. The algorithm has replaced the human, and the algorithm is owned by someone else. Someone who profits every time that number is checked. Fair and Isaac thought they were creating efficiency. What they actually created was a system where you're scored like a commodity, and the score isn't yours, it's theirs. Architect number 2, Senator William Proxmire. By the late 1960s, credit bureaus were out of control. Retail Credit Company, which later became Equifax, employed 40,000 investigators who compiled reports not just on your debts, but on your character. They reported on your sexual orientation, your drinking habits, your political affiliations, even rumors from your neighbors. This information was sold to employers, landlords, insurers, anyone willing to pay, and you had no right to see what they were saying about you. No right to correct errors. No recourse if they destroyed your reputation with lies. Congress held hearings. The abuses were staggering. People denied jobs because of false information they could never see. Families unable to get credit because of reports they couldn't challenge. It was a nightmare. Senator William Proxmire of Wisconsin, chairman of the Senate Banking Committee, saw an opportunity. He shepherded through the Fair Credit Reporting Act in 1970. President Nixon signed it into law on October 26th. It took effect April 25, 1971. On its face, the FCRA was consumer protection. You could see your credit report once a year. You could dispute errors. Bureaus had to investigate disputes within 30 days. Negative information had to be removed after 7 years, 10 for bankruptcy. Only entities with permissible purpose could access your report. It looked like a win for consumers. Finally, rules. Finally, rights. Finally, protection. But here's what the FCRA actually did. It legitimized the credit bureau industry. By regulating them, Congress gave them official sanction. They weren't rogue companies anymore. They were part of the legal infrastructure of American finance. And here's the critical detail nobody talks about. The FCRA gave credit bureaus immunity from defamation lawsuits. Before 1970, if a credit bureau published false information about you that damaged your reputation, you could sue them for defamation. After 1970, you couldn't. Your only recourse was to dispute the error through the bureau itself, the very entity that got it wrong in the first place. The bureaus weren't liable for errors. The furnishers of information, the banks, the creditors, they were technically liable. But good luck suing Bank of America, and the burden of proof was on you. You had to prove the information was wrong. They didn't have to prove it was right. The FTC started enforcement immediately. In 1972, they brought their first FCRA case against Credit Bureau of Lorraine. In 1980, they sued Equifax for reporting information more than 7 years old. In 2000, they ordered TransUnion to stop selling credit information for marketing lists. But the settlements were pocket change. A few $100,000 here, $250,000 there. Nothing that would actually hurt these companies. And the bureaus kept growing. By the 90s, the Big Three had consolidated hundreds of local credit bureaus into a national oligopoly. Equifax, Experian, TransUnion. 90% of all lenders used them. There was no alternative. There was no competition. There was no escape. William Proxmire thought he was protecting consumers. What he actually did was enshrine credit bureaus as permanent gatekeepers of American financial life with legal protections that made them nearly impossible to challenge. This is the second lock. The companies that score you are now legitimate. They're regulated, which sounds good, but regulation gave them government blessing. And the law protects them more than it protects you. Proxmire died in 2005, probably believing he'd helped people. He hadn't. He'd locked them into a system where private companies control their financial identities with legal immunity. The trap was tightening. Architect number 3, Fannie Mae and Freddie Mac. By the early 1990s, FICO scores existed, but they weren't universal. Lenders could use them, ignore them, use their own systems, rely on human underwriting. Credit scores were one tool among many. Mortgages especially still involved heavy human review. Loan officers looked at employment history, debt-to-income ratios, down payments, references. The process took weeks. It was expensive for lenders, but it allowed for discretion, for exceptions, for human judgment. Then in 1995, everything changed. Fannie Mae and Freddie Mac made a decision that would reshape American life. These are the government-sponsored enterprises that buy and securitize most American mortgages. They don't lend money directly. They buy mortgages from banks and package them into mortgage-backed securities sold to investors. This system provides liquidity to the mortgage market. It's how banks can make new loans instead of waiting 30 years to get paid back. But here's the key. Fannie and Freddie set the rules. And in 1995, they set a new rule. All mortgage lenders must use FICO scores as part of their underwriting process. Not suggested, not recommended, required. If you wanted to sell a mortgage to Fannie or Freddie, you had to run FICO scores on every applicant. Minimum score requirements, initially around 620, became the gateway to home ownership. Overnight, the FICO score went from optional to mandatory for the largest financial decision most Americans ever make. And here's where the trap sealed shut. Once mortgages required credit scores, everyone else followed. Auto lenders adopted them. Credit card companies made them standard. Landlords started requiring them. Employers began checking credit. Utility companies demanded credit checks. Insurance companies used them for pricing. By 2000, your FICO score controlled every major financial decision in your life, not because you agreed to it, because Fannie and Freddie made one policy decision in 1995. Now the system is complete. You need credit to build credit. You need a score to get a score. The score follows you everywhere. Can't get a mortgage, can't build equity. Stuck renting, where rent doesn't improve your credit. Can't get a car loan, can't get to work reliably. Might lose your job. Score drops further. Low credit score. Higher insurance premiums. Higher utility deposits. Denied for apartments. Sometimes even denied for jobs because employers run credit checks. It's a spiral. And here's the math that nobody shows you. Someone with a 620 credit score versus someone with a 760 on a $300,000 mortgage pays 2 to 3% more in interest. That's $60,000 to $90,000 more over 30 years. $60,000 to $90,000 extra because of a number. Where does that money go? Straight to the bank's profit. The lower your score, the more you pay for everything. It's a poverty trap disguised as risk management. And Fair Isaac Corporation, FICO, they're making a fortune. The company went public in 1987. Today, $1.3 billion in annual revenue, $8.3 billion market cap. 90% of top lenders use FICO scores. 10 billion FICO scores are purchased every year. At $1 to $3 per score, that's pure profit. You pay nothing. You benefit nothing. But they profit from you. Every time someone checks your score, FICO gets paid. Every time you apply for credit, FICO gets paid. Every time a landlord screens you, FICO gets paid. The people who made the decision at Fannie and Freddie probably thought they were increasing efficiency, reducing bias, making lending fair. What they actually did was turn financial identity into a single, portable, inescapable number. This is the third lock. The score is now mandatory, not optional. Not one factor among many. The primary factor, the gatekeeper. And there's no way around it. Architect number 4, the Big Three oligopoly. Here's who owns your financial identity. 3 corporations. That's it. Equifax started in 1899 as retail credit company. 2 grocers in Atlanta keeping lists of who paid their tabs and who didn't. By 1920, they had offices throughout the United States and Canada. By the 1960s, they employed investigators compiling reports on people's character, not just their credit. Sexual orientation, drinking habits, political beliefs, neighborhood gossip, all for sale. After the congressional hearings exposed their abuses, they changed their name to Equifax in 1975 to clean up their image. Today, 820 million consumer files, $5.1 billion in annual revenue, 14,000 employees. Experian's roots go back to 1826, Manchester, England. Tradespeople sharing information about customers who didn't pay. The American branch started in 1897 as Merchants Credit Association, later acquired by TRW, then spun off as Experian in 1996. Today, 245 million consumer files in the United States. Operates in 30 countries. $6.3 billion in revenue. 22,000 employees. TransUnion started completely differently. In 1968, it was the parent company for a railroad tank car leasing business. The next year, they bought the Credit Bureau of Cook County, Illinois. Instantly acquired 3.6 million credit files. Realized credit reporting was more profitable than railroad cars. Shifted focus entirely. Today, 1 billion consumer files globally. 200 million in the US. 3.3 billion in revenue. Here's how the oligopoly works. Banks and creditors voluntarily report your payment information to the Big Three. They're not required to report to all 3. They're not required to report at all, but they do because they also buy information from the bureaus. It's a data sharing cartel. Banks feed information to the bureaus. The bureaus compile it. Then they sell it back to the banks and to anyone else with a permissible purpose. You never consented to this. You never signed a contract with Equifax, Experian, or TransUnion, but they have files on you, and they profit from you. About $14 billion per year combined. And here's the nightmare. The Big Three don't have identical information. Bank of America might report to Equifax and TransUnion, but not Experian. Discover might report to all 3, but with different dates. Your score at Equifax might be 720. At Experian, 680. At TransUnion, 705. Which one matters? Depends on which bureau your lender checks, and you have no control over that. But here's where it gets worse. When they make mistakes, and they make mistakes 25% of the time according to the FTC, you have to fix it. Not them. You. You file a dispute. They have 30 days to investigate. Their investigation means sending your dispute to the furnisher, the bank that reported it, and asking, "Is this right?" The bank usually responds yes without actually checking. Dispute denied. Your credit stays damaged. You can't sue them for defamation, thank you, Senator Proxmire. You can only sue for FCRA violations. Failing to investigate, failing to correct, failing to respond. Good luck proving that. And even if you win, statutory damages are capped. Look at the Equifax breach. September 2017. Equifax announced hackers stole data on 143 million Americans. Social security numbers, birth dates, addresses, driver's licenses, everything needed for identity theft. Equifax discovered the breach July 29th but waited 6 weeks to tell anyone. 3 executives sold $1.8 million in stock before the announcement. The settlement? $700 million. Sounds like a lot until you realize Equifax's revenue that year was $3.4 billion. The fine was pocket change. And victims? Maximum payout around $125 to $425 each. If statutory caps had applied, 1/3 of a penny per person. This is the fourth lock. 3 corporations control your financial identity. They profit from your data. They make errors you have to fix, and they face no real accountability. The oligopoly is complete, the trap is sealed, and you have no choice but to participate. The error problem and accountability failure. Now let me show you what happens when this system gets it wrong, and it gets it wrong constantly. 25% of credit reports contain errors. That's 1 in 4 Americans. The FTC's own study in 2012 found that 5% have errors serious enough to result in higher interest rates. Wrong accounts that aren't yours. Incorrect balances. Paid debts showing as unpaid. Your file mixed up with someone who has a similar name. Here's what you have to do to fix it. You file a dispute with the Bureau. They have 30 days to investigate. Sounds reasonable until you understand what investigate actually means. The Bureau sends your dispute to the furnisher, the bank that reported the wrong information, and asks one question. Is this right? The bank looks at their records, sees the same wrong information, and responds yes. Dispute denied. Your credit stays damaged. The average dispute takes 3 to 6 months to resolve. Multiple attempts, phone calls, letters. Documentation you have to gather and send. And the whole time, your score is wrong. Costing you money. Costing you opportunities. And here's the legal trap. You can't sue them for defamation. Thank you, Senator Proxmire and the 1970 FCRA. You can only sue for FCRA violations. Failing to investigate properly. Failing to correct. Failing to respond. The burden of proof is entirely on you. You have to prove they violated the law. Good luck with that. And even if you win a class action lawsuit, statutory damages are capped at $500,000 total, not per person, total. Look at what happened with Equifax. September 2017, they announced a data breach. Hackers stole information on 143 million Americans. Social security numbers, birth dates, addresses, driver's license numbers. Everything you need to steal someone's identity. Equifax discovered the breach on July 29th. They waited 6 weeks before telling anyone. During that time, 3 executives sold $1.8 million in company stock. The settlement? $700 million. Sounds massive until you realize Equifax's revenue in 2019 was $3.4 billion. The fine was 20% of 1 year's revenue. Cost of doing business. And the victims? Maximum payout around $125 to $425 each. If the statutory cap had been applied, it would have been 1/3 of a penny per person. This isn't an isolated incident. In 2000, the FTC fined Equifax, Experian, and TransUnion $2.5 million combined for blocking consumer phone calls. In 2003, Equifax was fined again. Same violation, $250,000. In 2013, a federal jury awarded $18.6 million to Julie Miller. Equifax had merged her credit file with another person who had a different social security number, different birth date, different address. Miller called them repeatedly, sent letters. They refused to fix it. In 2021, TransUnion was fined $60 million for improperly matching people's names with terrorist watch lists. Sergio Ramirez, the lead plaintiff, was tagged as a drug kingpin because his name matched someone on a government database. The pattern is clear. They make massive errors. They refuse to fix them. They get fined. The fines are pocket change. They keep operating. Nothing changes. Your financial identity is in the hands of companies that make mistakes constantly and face no real consequences. The complete system, how it all connects. Let me show you how the 4 architects built the inescapable trap. Layer 1, Bill Fair and Earl Isaac in 1989. Your financial identity becomes a 3-digit number generated by a secret algorithm. Layer 2, William Proxmire in 1970. The companies creating and selling that number get legal immunity and government legitimacy. Layer 3, Fannie Mae and Freddie Mac in 1995. The number becomes mandatory for mortgages, then cascades to every other financial decision. Layer 4, the Big Three consolidate in the 1990s. 3 corporations form a protected oligopoly with no alternatives. Now you're trapped. Here's why you can't escape. You can't live without credit. 50% of employers check credit before hiring. Over 90% of landlords require credit checks. Utilities require credit checks or massive deposits. You cannot function in modern America without participating in this system. But here's the catch. You can't build credit without already having credit. No credit history means you're unscorable. Unscorable means you're denied for credit cards and loans. Classic catch-22. You can't fix errors without fighting the people who made them. Dispute resolution is controlled by the bureaus themselves. The 30-day investigation is often just a rubber stamp. It can take 6 months and multiple attempts to fix something that was never your fault. You can't sue effectively. Statutory damages are capped. Arbitration clauses in many credit agreements block you from court. Class actions yield pennies per person while companies keep billions. You can't opt out. Even if you never use credit, the bureaus compile files on you from public records. Rental history, utility payments, traffic tickets, court records. You're in the system whether you consent or not. You can't see the formula. FICO's algorithm is a proprietary trade secret. You know the general factors, but not the exact calculations. You cannot fully understand the judgment being made against you. You can't escape the oligopoly. 3 companies control everything. 90% market share. No viable alternatives. Government regulated but not accountable to consumers. And while you're trapped, they're profiting. FICO makes $1.3 billion in annual revenue. $8.3 billion market cap. 10 billion scores sold every year at $1 to $3 each. Pure profit. You pay nothing. You benefit nothing. They profit from you. The big 3 combined make over $14 billion in annual revenue. 25 to 30% profit margins. Selling your data that you never agreed to give them. Banks use your score to charge higher interest. Someone with a 620 score versus a 760 score pays 2 to 3% more on a mortgage. On a $300,000 loan, that's $60,000 to $90,000 more in interest over 30 years. That money goes straight to bank profits. The lower your score, the higher your costs for everything. Higher interest rates. Higher insurance premiums. Bigger utility deposits. Can't get a mortgage so you rent forever. Building someone else's equity instead of your own. The system is designed to keep people trapped. And at every level, corporations profit while you pay. 4 architects, 7 decades, 1 inescapable system. Bill Fair and Earl Isaac turned your financial identity into a number you don't control. William Proxmire legitimized the companies selling it and gave them immunity. Fannie Mae and Freddie Mac made the number mandatory for the biggest purchase of your life. The big 3 created an oligopoly with no alternatives. None of them conspired together. They lived in different eras, but each solved a problem in a way that benefited corporations. And each solution built on the previous one. The result is 200 million Americans judged by a secret algorithm, scored by 3 corporations they never chose, with no ability to opt out. Challenge the formula or escape the consequences. Your financial identity is owned by FICO and the big 3. They profit from it. You bear all the risk of their errors. The law protects them, not you. This isn't a bug in the system. It's the system working exactly as designed. They won't teach you this in school. They'll teach you to build your credit, monitor your score, pay on time. That's advice on succeeding within the trap, not seeing that the trap exists. 4 architects built it, and we're all caught inside it.